Hello, everyone, and welcome back to the Financial Freedom Show. If you're new here, I like to dive into the world of personal finance, investing, and building wealth over time. Today, we're going to look at one of the most popular ETFs out there, the Schwab US Dividend Equity ETF, otherwise known as ticker symbol SCHD. This ETF has gained quite a reputation for its solid dividend payouts and impressive performance. But what makes SCHD stand out, and how does it work? And more importantly, is it right for your investment portfolio? We'll answer all these questions and more, so let's get started. Let's start with the basics. The Schwab US Dividend Equity ETF, or SCHD, is designed to track the performance of the Dow Jones US Dividend 100 Index. This index is comprised of 100 high dividend yielding US companies that have a record of consistent dividend payments and solid growth fundamentals. SCHD was launched in October 2011, and it has quickly become one of the go-to ETFs for dividend investors due to its low expense ratio, high dividend yield, and strong performance. It's also managed by Charles Schwab, which is one of the largest and most respected financial services companies in the world. So how exactly does SCHD work? The ETF tracks the Dow Jones US Dividend 100 Index, which selects stocks based on several criteria, including dividend yield, dividend growth rate, payout ratio, and return on equity. To qualify for inclusion in the index, a company must have a minimum of 10 consecutive years of dividend payments. This ensures that companies in SCHD have a proven track record of rewarding shareholders with consistent dividends. Additionally, companies are screened for financial strength, meaning that they must have a solid balance sheet and strong cash flow in order to continue paying dividends even in tough economic times. The index is reconstituted annually, meaning that the stocks in the ETF are reviewed and adjusted once a year to ensure that they still meet the criteria of the ETF. This process helps maintain the quality and reliability of the holdings in SCHD. So let's take a closer look at what's in SCHD. As of the latest data, SCHD holds 100 stocks, with the top sectors being information technology, financials, consumer discretionary, and healthcare. The top holdings include typically well-known companies like Pepsi, Coca-Cola, Pfizer, and Verizon. These are companies with strong brands, wide moats, and consistent cash flows, making them reliable dividend payers. What's particularly interesting about SCHD is that it doesn't just focus on high dividend yield stocks. It also considers factors like dividend growth and payout ratios, which means that the ETF includes companies that not only offer a good yield now, but also have the potential to increase their dividend yield over time. This approach helps balance the need for current income with the potential for future income growth, making SCHD a great choice for both income-focused and growth-oriented investors. Now let's talk about performance. SCHD has been a strong performer since its inception, delivering solid returns in both terms of price appreciation and in dividend growth. Over the past 10 years, SCHD has provided an annual average return of around 13%, outperforming many of its peers and even some broad market indexes. But the real highlight of this ETF is its dividend yield. SCHD yields anywhere from usually 3.5 to 4%, which is very high compared to the S&P 500's dividend yield and other focused dividend ETFs. This yield is especially attractive in a lower interest rate environment, which I think we're heading into pretty soon, where traditional income investments like bonds are offering lower returns. In addition to a solid yield, SCHD has a strong history of dividend growth. This growth is a key factor for long-term investors who are looking to build a reliable income stream that keeps pace with inflation. So now that we've covered the fundamentals of SCHD, let's dive into something that's been on the minds of many investors lately, the growth versus value debate. Over the past decade, growth stocks have been in the spotlight of the market, leaving many dividend-focused and value-oriented ETFs like SCHD in the shadows. But today, I want to make the case for why SCHD could be set to potentially outperform in the coming years. Nobody knows for sure or has a crystal ball and can tell what's going to happen in the market. But if you're thinking about where to allocate your capital in this changing market environment, stick around because this is going to be an important discussion. Let's start with the macroeconomic environment. Over the past few years, we've seen a significant shift in the overall economic landscape, with rising interest rates and inflation becoming a persistent concern. The market dynamics are changing. Historically, growth stocks, which are often characterized by higher valuations and lower dividend yields, have thrived in a low interest rate environment. However, as interest rates have risen, the appeal of growth stocks tends to diminish. Why is that? Well, when interest rates are low, the future earnings of growth companies are discounted less, making them more attractive. But as rates rise, those future earnings become less valuable in today's terms. This environment often leads to a rotation from growth stocks to value and income-generating assets like SCHD. SCHD, with its focus on high-quality dividend-paying companies, stands to benefit in this environment. Investors are likely to seek out stable income-generating investments that can provide consistent returns even as market conditions become more volatile. Another key factor to consider is the strength of dividend growth companies. SCHD isn't just about high yields. It's also about investing in companies that have a long history of growing their dividends over time. Why is this important? Dividend growth is often a signal of a company's financial health and its ability to generate consistent cash flow. During periods of market uncertainty or economic downturns, companies with strong dividend growth records tend to be more resilient. They have more discipline in capital allocation strategies, often maintaining or even increasing dividends, while other companies might struggle. SCHD's focus on these types of companies means that it could offer both stability and growth in a more challenging market environment. This resilience is especially crucial in a market where volatility is expected to increase. The combination of rising interest rates, geopolitical tensions, and economic uncertainties makes dividend growth companies an attractive option for investors who are seeking both income and capital appreciation. Let's talk about valuations. Over the past decade, growth stocks have enjoyed a massive run, leading to significantly higher valuations compared to the historical average. Meanwhile, many dividend-focused and value-oriented stocks have been left behind. But here's the thing, markets tend to revert to their mean over time. What goes up must come down, and what's been overlooked often catches up. As growth stocks become increasingly expensive, their potential for future returns diminishes. On the other hand, many stocks in SCHD are trading at many reasonable valuations. This creates an opportunity for SCHD to outperform as investors seek out more reasonably priced assets that offer a combination of income and growth potential. Valuation reversion is a powerful force in investing. While growth stocks have been the darlings of the market, history shows us that value stocks, and by extension value-oriented ETFs like SCHD, often see periods of strong performance following periods of underperformance. Another reason to be optimistic about SCHD's prospects is the earnings quality and cash flow stability of its holdings. The companies within SCHD aren't just paying dividends, they're doing so out of solid, consistent earnings. In times of economic stress, companies with strong cash flow and stable earnings are more likely to maintain or even grow their dividends, which can provide a buffer against market volatility. Earnings quality matters because it reflects the stability of a company's operations. Companies with strong cash flows and high earnings are quality and better positioned to weather economic downturns, making them safer bets in uncertain times. SCHD's focus on these kinds of companies is a key reason why it could outperform as the market shifts its focus from high-flying growth names to more stable income-generating assets. The stability is particularly valuable as we move into a period of potential economic slowdown or recession. Investors are likely to favor companies that can generate reliable income and maintain strong balance sheets, which plays into SCHD's strengths. SCHD is perfectly positioned to meet all this demand. Its focus on high-quality dividend-paying stocks makes it an attractive option for retirees and other income-focused investors. Moreover, as investors move to income-generating assets, the increased demand could also drive up the prices of SCHD's holdings, leading to capital appreciation on top of the dividend income. This dual benefit makes SCHD an appealing choice for those looking to balance income with potential growth. One of the biggest selling points of SCHD is its low expense ratio. The ETF has an expense ratio of just 0.06, making it one of the cheapest dividend-focused ETFs available. This low fee structure is a major advantage for investors because it means that more of your returns stay in your pocket rather than going towards management fees. Low costs are crucial for long-term investors, even as small differences in fees can add up to significant amounts over time. SCHD's low expense ratio combined with its strong performance makes it an incredibly cost-effective option for those looking to invest in high-quality dividend-paying stocks. While SCHD offers many benefits, it's also important to consider the risks as well. First and foremost, SCHD is still an equity ETF, meaning that it's subject to market risk. If the overall stock market declines, the value of SCHD will likely decline as well. Another risk to consider is sector concentration. While SCHD is diversified across 100 different companies, it does have a significant allocation to certain sectors like the information technology and financial sectors. If these sectors were to underperform, it could impact the ETF's performance. Additionally, while SCHD focuses on high-quality dividend-paying companies, there's always a risk that these companies could cut or suspend their dividends, especially in times of economic stress. This could negatively impact the ETF's yield and total return. Lastly, it's important to remember that while SCHD's dividend yield is attractive, it's not guaranteed. Dividend payments can fluctuate based on the underlying company's performance and management decisions. If we're going into a recession, they could potentially cut their dividend yield. So is SCHD the right investment for you? It really depends on your investment goals, risk tolerance, and time horizon. If you're looking for a cost-effective, diversified ETF that holds a strong dividend yield and the potential for dividend growth, SCHD is definitely worth considering. SCHD is particularly suitable for income-focused investors, retirees, or anyone looking to build a reliable income from dividends. It can also be a great option for those looking to balance income with potential capital appreciation over the long term. However, if you're seeking higher growth potential or are more comfortable with taking on additional risk, you might want to explore other options such as growth-oriented ETFs. In conclusion, the Schwab US Dividend Equity ETF, or SCHD, is a powerful tool for dividend investors. It offers a compelling combination of high yield, dividend growth, low costs, and diversification. Whether you're just starting out or looking to enhance your income strategy, SCHD could be a valuable addition to your portfolio. Here's a few final tips before I go. Number 1, always consider your risk tolerance and investment goals before choosing an investment. Number 2, always keep an eye on the underlying company's financial health and dividend policies. Number 3, diversify your portfolio to mitigate risks associated with sector concentration. And number 4, reinvest dividends to take advantage of compound growth over time. If you found this video helpful, please be sure to give it a thumbs up, and don't forget to subscribe for more personal finance and investing content. Drop a comment down below if you have any questions or if there's a specific ETF you'd like me to cover in a future video. Thanks for watching, and I'll see you in the next one.